Okay, I think we can start. A very warm welcome to our event here today on savings, from savings to sustainability, long-term investors in Europe's green transition. My name is Guntram Wolf. I'm a senior fellow here at Bruegel, as well as a professor of economics at the Université Libre de Bruxelles, where I hold a chair, Euroclear chair in sustainable finance. And I'm really pleased today to moderate this event with really great speakers. So let me start introducing our speakers. We will start with a presentation by Philippe Uschev, my colleague at the university in Brussels. And Philippe will present a joint, you will see somewhat theoretical paper that we've been working on, and we thought it's important to actually go into some theory to understand really the link between long-term investment and the green transition. Following his brief presentation, no more than 10 minutes, we have a stellar panel that will discuss the topic not just based on the paper, but of course based on the backgrounds of our participants. So Stuart Cox is Director of the Climate Finance and Corporate Action Program at the European Climate Foundation. Nathalie Layani, correctly pronounced, she's Director of the Chief Sustainability Officer at the Caisse des Dépôts Group. And she just told me that when she started at Caisse des Dépôts, the concept of long-term investment really was starting to take patient finance started to really become important. So I'm sure you will tell us about that. Silvia Merla is online on the screen, already visible. Thank you so much, Silvia, for joining. You are, of course, a non-resident fellow at Bruegel. And in your real job, you work at a major investment firm. And last but not least, Caroline Nährlich. She is lead economist in the Director General Economics of the European Central Bank, and I think you worked in the Climate Center also at the ECB. So I think we have really a great set of speakers. And so, not to lose any time, we start directly with you, Philip. 10 minutes.
Thank you, Guntram, for the introduction. Thanks, everyone, for being here, and thanks to Bruegel for having me here. So, just like Guntram said, I'm the nerdy academic guy who is going to present the theory part on what Guntram and I are working together. And the purpose is basically to address three sets of stylized facts. So the first set of stylized facts is about... So the first set of stylized facts is about long-term investors caring more about green investment. So there is some correlation in the data between the long-term holdings and the sustainable investment. Second set of stylized facts is about the size effect. It turns out that larger countries tend to invest more into green. And the third set of stylized facts is actually about inequality and dispersion. So more inequality in more cross-country inequality in GDPs actually leads to higher global green investment. And what we do in this paper is provide a simple model which rationalizes these three sets of stylized facts. So the key idea of our model is that we bring together sustainable finance and private provision of public goods. So we treat green investment as a public good. I will explain why. So there is a bunch of agents where each agent is to be thought of as a representative agent for a country. And agents differ in two dimensions. Their time preference, some agents are more patient, some are less patient, and in terms of wealth. So some investors have higher wealth, some have lower wealth. And the green assets, the green bonds, they pay a lower return, but at the same time they contribute to increasing the probability of preventing major climate collapses. And so here is the model. So we have these agents who are different in 2 dimensions, and it's a very, very simple model. So in terms of behavioral assumptions, we assume full selfish rationality, like the Homo economicus textbook thing. So there is no motives like altruism, like warm glow, nothing. Agents just what they do. They optimize their portfolio choice, taking into account the information about what's happening. There are 2 types of assets, conventional assets and green assets. And green assets pay, under normal circumstances, a lower return. So there is a positive greenium. There is a positive greenium here. So basically, what the aggregate green investment does, it basically affects the probability that there is no major climate collapse. And in the case of major climate collapse, the positive fraction of capital just gets destroyed. So the returns on both types of assets have to be adjusted. So here is the only technical slide. Basically, the 2 key equations of the model, one of them being the standard Euler equation, which captures the trade-off between present and future consumption. But the other one here is basically the main novelty of the paper. It basically captures the idea that the marginal benefits of green investment, which stem from increasing the probability of preventing the climate collapse, times this delta U is just the utility differential between the 2 states. One is the good state when there is no collapse, the other one is bad state when there is collapse. So this marginal benefit actually equals the marginal cost of investing an additional unit of wealth into green, which is the greenium times the expected disutility, the expected marginal disutility of giving up an extra future consumption unit. So that's it, very simple structure. And everything is conditional on capital G, which is the green investment. So just because the probability distributions involved are dependent on how much everybody in total invests into green. So that's the environment, the insurance, sort of the insurance impact of the green investment against the major climate crisis. So there are 3 sets of predictions our model makes, and they are perfectly aligned with the 3 sets of stylized facts I mentioned when I just started. So the first set of predictions is about, the first prediction is about more patient agents have a higher share of green holdings in their portfolios. Second prediction is agents with higher wealth have higher shares of green holdings in their portfolios. And the third one, last but not least, more heterogeneity in either of these, either in time preference or in wealth, actually leads eventually to higher aggregate green investment. Just a small numerical illustration of the 3 predictions. So the 3 lines capture the green investment of the blue line is for the more patient investor, the red line is for the less patient investor. It's a very simple special case, a model with just 2 investors. As the gap between the 2 time preference indicators, which we model as discount factors, increases, the more patient guys' investment into green becomes higher, and the less patient guys' investment into green becomes lower. And the black dotted curve is the average, so you can see that the average, hence the aggregate, starts increasing when the less patient guy's green investment hits the zero. So same thing about more inequality in wealth. So basically on the horizontal axis here is the gap in wealth. And we kind of see the same picture. And you see when the gap increases, the average green investment also starts to increase. And let me conclude with just illustrating what we find in the data. So this first figure basically shows you a positive correlation between long-term holdings and sustainable investment. So the line is positively sloped clearly. This second one is the size effect. So on the horizontal axis here we have the regional PPP GDP, and on the vertical axis we have the share of renewable energy as a proxy of green investment. So again, positively sloped trend. And the third figure is on the this one is a bit more subtle. So on the horizontal axis, we have the coefficient of variation, basically a measure of inequality, cross-country GDP inequality. Each dot here corresponds to a certain year. So basically, on the vertical axis, we again have a proxy for green investment. So the line is positively sloped again. And so let me skip the extensions and just jump to the conclusions. We basically have three sets of findings, both theoretical and with some support from the evidence. So more patient investors tend to invest more into green. Wealthier investors or bigger investors, if we consider the wealth or the proxy for the size, tend to invest more in green, and more heterogeneity or more dispersion, more inequality leads to higher aggregate green investment. These findings, although we don't do a policy evaluation exercise here, they kind of invite to think about certain policy implications, like should we maybe reassess the regulations for long-term investors when facing green assets, or how should we think about climate clubs? Like a bigger climate club means both exploiting the size effect and heterogeneity. And we are also thinking about, possibilities of having better microdata and better empirical testing ideas. And on that front, as well as on any other front, your feedback and your suggestions are highly welcome. Thank you very much.
Wonderful. Thank you so much, Philip. And it was exactly 10 minutes. That's perfect. So this is, I think, a nice sort of setting of the scene. And I really want to turn directly to our three speakers or three panelists today. To our four panelists, so we can put Sylvia back on the screen, if possible. Yes, exactly. So. Now you're back, Sylvia. Put our four speakers back. So I would suggest we start perhaps with you, Natalie, because you already mentioned that the patience of investors is quite important in sustainability. So please.
Well, many thanks, and many thanks for having me at this very interesting conference. So I'm Natalie Laiani, Chief Sustainable Officer at Groupe Caisse de Dépôt. And first of all, I would like to describe you a little bit Caisse de Dépôt so you can understand what I will share with you about the way we invest in the long term, especially in the climate and ecological transformation sector. Caisse de Dépôt Group is kind of a climate club as its own, just to follow up on what has just been presented. Because we aggregate a lot of public or para-public financial institution in France. That is to say, Caisse des Dépôts itself that manages savings and legal deposits, but also BPI France, which kind of the National Public Development Bank, and Groupe La Poste, which is the equivalent of a postal services company everywhere in Europe, and other companies in the general interest sector. And I would say that in terms of sustainable finance, we play two different roles. One is the role of responsible investor, as we're an asset owner managing very large asset portfolios, and we use our power as an investor in order to have companies themselves invest in transition, in climate transition. And we also have a role of public development bank, financing all, I would say, strategic public objectives in France, and especially ecological transformation. And so in 2020, we chose to adopt a very ambitious objective, which is to mobilize 100 billion euros over 5 years, all of the group Caisse des Dépôts, in order to finance climate and biodiversity French objectives. And so these 100 billion euros aggregate all the financing that are managed by Caisse des Dépôts Group in loans and investment, and that are targeted to renewable energies capacity financing at local municipalities level, low carbon transportation, building refurbishing, etc., etc. And you may ask, how could we mobilize these large amounts of financing in loans and investment? Well, first of all, it's because precisely we are a long-term investor, so we have the capacity to be patient, that is to say, to expect profitability in the long run, with a 10, 20, even 30 years time lapse. And when we lend to local municipalities, we can lend on the very long run, even towards 80 years before we get totally reimbursed on our loans. And the other specificity of Caisse des Dépôts as a long-term investor, as other European long-term investors, I think of KfW or Cassa Depositi, is that we can expect lower return on investment on our investments in the sustainability sector. Well, usually private investors expect 2 digits returns on investment, 12% or 14% return on investment. We have the capacity to accept 6 or 7% returns on investment in the climate or in the ecological transformation sectors, which is quite important if you want to reach and fill the gap of investment needed in order to reach the European objectives in terms of climate. I would like just to remind one figure. It is the figure of the gap of investment that would be needed in order to achieve EU's 2030 climate objectives. In order to reach this objective, we would need to mobilize around 6% of EU's GDP. For the moment, we're only at 3%. We would need to mobilize each year 800 billion euros of investment in the climate sector. For the moment, we're around 400 billion. These are the figures that I foresee, a French think tank dedicated to climate economics has come up with, so you can consult their study on this. Well, and in order to fill that gap, and I would end up with that, we need to coalesce all these European long-term investors and mix private and public financing in order to fill this gap.
Wonderful. Thank you so much. Thank you so much. This was very complimentary, and of course, it's great that you reminded us that the green transition is a very long-term issue, and it requires actually a lot of resources. I mean, we I think with Jolt, we did compute some numbers as well. And indeed, it's several percentage points of GDP. I mean, how many exactly? But it's certainly 2 percentage points of GDP in investment per year to get the green transition done. So my proposal is next we hear from Stuart, then we have Sylvia and Caroline, last but not least. Stuart, please.
Thanks, Countryman. Thank you for having me. I think looking at the role of long-term investors in the transition, I think one of the ways that we can improve that role is looking at how fit for purpose the transition planning framework is in the EU. So in terms of where we are now, the EU actually has built one of the most comprehensive transition planning frameworks in the world. So whether that's CSRD for disclosure, the taxonomy for activity classification, SFDR for transparency, the foundations really are already there. But we've seen that ambition's been weakened, not least in the removal of the climate plan obligations under the due diligence directive. But we always knew transition planning wasn't just going to be about sort of legal obligations and had to be about market-driven implementation. So legally, there's not an obligation for companies to put these plans into effect. But in reality, we see CSRD requires firms to disclose these plans where climate's material for them. And we're seeing increasing reputational and investor pressure to have credible and actionable plans. So this really shifts the accountability model from something that's, a compliance exercise to something that's really driven by investor and public scrutiny. So in terms of how we can improve that transition planning framework, I think the first I would say is focusing on regulatory stability. We saw the omnibus last year created a lot of confusion, a sort of erosion of trust, sunk capital costs for firms, and really disrupted investor decision making at a time when we know, that gap needs to be met in terms of long-term investment. So personally, I think it's key that we don't reopen any more files beyond what's already under review and actually give some sort of stability in terms of the regulatory framework. Secondly, I think focusing on implementation quality and usability. So a lot of companies now in Europe do disclose transition plans or targets. CSRD's been a catalyst in driving some of that. But ultimately, many assessments of the data that's already out there shows that there are gaps, and the gaps in what's disclosed really undermine the usefulness of transition plans for capital allocation and risk management. So what can we do about it? I think strengthening technical guidance around that and building practical tools to really ensure that these plans can be developed in a way that's consistent and allows comparability and allows investors to have the sort of decision useful information that they've been asking for. The SFDR review also provides an opportunity to improve this as well. So the current regime has led to a lot of greenwashing concerns, and we obviously don't want to repeat the ambiguity around Articles 8, 9. So we really want to see SFDR categories that really drive real outcomes and have really clear criteria. There's also sort of two things, I think, outside of the sustainable finance framework we could look at in terms of driving this long-term investment in the transition. One is looking at the role of public finance. So there's a lot around sort of blended finance and how you can, put that together. But one other area I think is also looking at things like the next MFF or the European Competitiveness Fund, and actually linking access to these funds to companies having credible transition plans, so that resources are directed to those who are actually leading and not high-emitting incumbents. The EIB's sort of emerging climate criteria for companies shows the value of doing that sort of business model assessment and transition alignment, and it's something that should really be rolled out to all EU funds to ensure that they are accelerating, not delaying the transition. And then finally, I think long-term investors want to see long-term planning. So actually, when reopening things like the EU governance regulation, feels quite far away from finance, but actually looking at things like long-term strategies, national energy and climate plans, and actually linking them and giving the policy certainty over the medium term that allows investors to invest.
Yeah, thank you so much. I mean, you put a lot of emphasis on the regulatory issues, which of course deserve, I guess, a whole set of discussion on their own. But I'm sure also Sylvia has ideas and suggestions on that. But just to say, I mean, obviously it's important to have regulatory clarity. But of course, one also has to see if the regulatory clarity is overly bureaucratic. It's also an issue. So where exactly to strike the balance? You know, I haven't studied that, but certainly it's a very interesting question. And so thanks for bringing that up. Sylvia, I'm sure you have many things you want to say. Please.
Yes, thank you. And also thank you for the presentation. I will admit I haven't tried the full paper yet, but I will after this, because I think I have some technical comments that I would like to share. Going back to the original question, which was why do we need long-term investors and whether their role is really relevant for sustainability transition, I think this is really essential, in fact. And to borrow the framework of your paper, actually, the way you could sort of split this is by distinguishing between mitigation and adaptation. So in your Euler equation, when you effectively derive this difference between the long-term return of green investments, mitigation investment basically would reduce probability of default, and adaptation investment would reduce loss given default. So it's like two different types of sustainability focused investments that go in the different direction but produce a very similar result. And so why are long-term investors relevant, important for both either of these two concepts? So on mitigation, classically, the argument that is made is you need patient capital because, as you were also arguing at the beginning of your presentation, the financial incentive may not be strong enough for, so to say, the market to take care of it. So because there isn't such a big greenium, you will need a differently oriented types of investors, especially more patient for this kind of investment to be carried out at scale. And I think, in fact, that's correct. But I also think that when we look at the data, actually, that argument is missing a couple of points. So one is that when we detect greenium to be very small, there's a couple of caveats that I will make to this. The first one is that when we look specifically, for example, at green bonds, this is one of the areas where this calculation is often made. And specifically, if we look at EU green bonds, which now we have a label for that's been launched very recently, when we look at who is issuing specifically those bonds, these tend to be companies in sectors that are relatively easy to decarbonize. And oftentimes they tend to be companies that are already very advanced in their decarbonization process. And this, in a way, naturally compresses the greenium that you would be able to get from the instrument because of the fundamentals of the companies that are issuing being already very good from a sustainability standpoint. And then the other caveat that I would put out there is that a lot of companies may, at least from like what I see, putting on my financial market hat for a second, a lot of companies may not want to be confronted with the complexities of issuing an instrument with a specific label, but they would potentially still be using the funds for investing in green transition related activities. So the way that we would need to look at this would be to actually match CapEx plans and actually CapEx investments carried out by companies with the funds that I raise, and that would probably give us a better and more complete picture of where the money is going and whether, like the aggregate economy level, we do or do not have a higher return than the one implied by looking at financial instruments specifically. Now, that being said, on the mitigation side of things, I still think that long-term capital and patient investors are key because they are in a position of engaging over a long term with companies. And so, as Scott was just saying, drive implementation of transition plans, which sometimes does require active engagement from the side of capital to be carried out. And there, I definitely agree with the regulatory point that were made just before I spoke. And I also agree that I would take another hour to discuss everything. But like in short, it is essential for that patient capital to have complete disclosures, complete transparency, comparable data from companies regarding what they're doing in terms of their investment plans, their capex plans, their transition plans, to also have KPIs that can be assessed at a specific frequency, and that will form the basis of this long-term investment and long-term engagement activity. And I think, unfortunately, regulatory initiatives lately have gone in the opposite direction. So to deprive investors of this transparency and ability to have comparable data. So that is something that I would definitely support reviewing and have also in things that have been published with Google some time ago. So that's my point on mitigation. On adaptation, I think patient capital is even more important because there the market incentive is effectively inexistent or very, very low. So for enough capital to be deployed for adaptation investment, which will become, by the way, a lot more important because mitigation efforts are being weakened in several geographies around the world. There, even more so, it becomes even more important to have a framework that is really long-term in perspective and very patient in the nature in which the capital is managed. And on this, I think there's still a lot less work that has been done compared to the mitigation, which obviously has been very topical for many years now. So this is where I think a lot more interest going forward will probably focus, and rightly so. I'll stop here for the time being. And
thank you so much. Thank you so much, Sylvia. And I think this topic of long-term clarity that has to go hand in hand with long-term investment decisions and therefore the regulatory framework is perhaps a topic we want to come back. And Natalie, I want to come back to you after we hear from Caroline on exactly this question, because it sort of emerges, this regulatory issue emerges as, I think, one key dimension certainly of this space of long-term investment and sustainable investment. Caroline, please.
Yeah, thank you very much. And I may take a bit broader perspective on this topic, and congratulations for the nice paper. So, I mean, just to maybe reiterate that, of course, there are substantial green investment needs, and we come up with comparable figures in terms of annual investment needs, about 2.7 and 3.7% of GDP on an annual basis for the next year. So this is a lot of money, and this needs to be largely financed by the private sector. And given that the euro area and Europe is bank-based, of course, the bank financing will continue to play an important role there. But with respect to green investment, I mean, there is also, of course, a case for more market-based funding, and that has to do with the specificity of green investment, meaning that this is very often capital intensive. There are high upfront costs and capital needed at the beginning. But then, of course, if you think about green innovation, so new technologies that have to be developed, I mean, this also is linked a lot to risks. And for this, for the banking sector, this might be an issue in the sense that, I mean, there is uncertainty about the future value of the underlying collateral. So therefore, there is an important role for risk capital and also for long-term investors that do not necessarily focus on the short-term returns, and here pension funds, sovereign wealth funds, and I mean, of course, pension funds are playing an important role. So, I mean, when we look at the market-based funding, there has been a lot of progress, and we just heard about the green bonds, that there is an increase in issuance, but still it is starting from a very low level. So I mean, there is much more that needs to be done in this area, and we looked also at several barriers to green investment, and there was quite some interesting evidence from some surveys. So one of them, we just published the results in our latest economic bulletin, where this is based on earning calls with the large companies, and 57% of them claim that access to finance is an issue for them with respect to green investment. So this is indeed then really an important aspect to look at, and given the fragmentation of the capital markets in Europe, and also that risk capital is relatively underdeveloped. So this brings me to one of our favorite topics, deepening CMU, and because
SIUS it's called nowadays.
Well, yeah, this also includes then the banking union, but I mean, focusing on capital markets, I mean, we think that there are in particular 3 elements that are also important for green investment, and that's I mean, the creation of long-term saving products, the securitization to free up the balance sheets of banks, but also then, of course, to develop venture capital markets. And I mean, a few words maybe on transition planning. I mean, we fully share what has been said before. I mean, in our view, there are some basic criteria that would need to be taken into account. So it really needs to be credible. It needs to be assessed by an external, I mean, there should be an external verification process in order to avoid greenwashing. There needs to be certainty also in terms of the regulatory framework. I mean, that it is not always adjusted whenever there is some political pressure. And of course, it needs to be comparable also to avoid that there is some fragmentation coming via capital flows. And maybe a last word on the role of the public sector. I mean, there is, you also alluded to the EU budget and some other initiatives. I mean, this is also an important complementary source in funding the green investment, and blended finance is certainly an angle which needs to be further analyzed in our view.
Thank you so much. So we will take also questions from the audience, but before we do so, I want to have one last quick round. For those of you who join us online, you can ask questions on Slido. I'm already announcing this with the hashtag Green Transition. Caroline, I did want to sort of follow up on one short question, which is on the importance of banks. I mean, you mentioned the importance of banks. Is in your mind, in the regulatory framework, are there points where sort of the long-term nature of this investment, this green investment, particularly discourages banks from actually doing these kinds of lending?
Well, I think in a way, at least if you look from the practitioner or the applications perspective, I mean, we do regularly have a bank lending survey where we assess, I mean, to what extent capital, or I mean, the requirements are and also, I mean, the credit standards are kind of adjusted depending on the carbon intensity of the companies, and there we do find indeed reassurance in the sense that I mean, companies that have that are low emitting, they receive kind of a bonus for with respect to their credit risk premia, as compared to countries which are in the high emitting sectors. They do have to pay higher premia. So I mean, that there is already kind of a credible framework apparently, which is working, which is quite assuring.
Natalie, turning to you with also a more regulatory question. I mean, so one issue is about sort of the disclosure as a way of making it transparent in what you invest and giving the clarity on the long term. So this is one dimension which we need to discuss. I think the other dimension that we need to discuss is, of course, do institutional long-term investors, do they get penalized if they invest into more risky green assets or not? So perhaps you have a view on both. Would love to hear those 2 points, and then ask Sylvia and Stuart your last.
In terms of regulation, I would say that the biggest leverage is all the regulation related to climate risks and biodiversity risks, which is emerging. Well, from the very beginning of the movement of responsible investment that emerged around the COP21 was the idea that asset owners and investors have in their portfolios assets that are the value of which will be degraded and will decrease because these are exposed to climate risk, physical climate risk and transition climate risk. And that was the biggest driver in order to get these investors really engage and take action on decarbonization of their portfolio and invest in green assets. And so the first proposal I would like to make is really to promote regulation on climate risk, physical and transition risk, and to think again of this old idea of having a green asset ratio in terms of prudential regulation, at least a bonus for investors that finance massively green assets, because they mitigate their exposure to climate risk, and so they reduce the systemic financial risk. That's the first thing, and I would like to answer something that the speaker, another speaker said about mitigation and adaptation. We have great difficulties to compute and follow up our financings on adaptation. We can define positive side effects of investments in biodiversity or mitigation that create adaptation effects, but it is still quite difficult to really track investment that are dedicated to adaptation. I close the parenthesis on that. As regards regulation again and data availability, I totally agree on what has been said before. In order to mitigate our climate risk, we need to get access to, of course, ESG data from our counterparts, and some of our counterparts are not subject to CSRD, and those who were, for a large part of them, won't be anymore subject to CSRD, which is a great problem. In order to really continue to abide by all the commitments that we took on portfolio decarbonization and more broadly on responsible investment. And we're quite worried about this concept of value chain cap, which could, for the moment, it's really focused on CSRD reporting. But we're a bit worried that this concept could be used by any kind of counterparts or listed companies that are under the thresholds of CSRD, and that could come up and start to challenge shareholders' dialogue and all the demands and the requirements that are made by responsible investors. So we avoided that risk, but it's still on the table. And as regards green bonds, that is one of the greatest tools in order to also finance and close the gap in order to reach environmental objectives in Europe. The problem we are confronted with is here again the lack of ESG data from our counterparts that are local municipalities, that are SMEs, that of course don't publish ESG data. So there are no aspects of bureaucracy in all in what I've said. The stakes about data availability are have nothing to do with bureaucracy or simplification. They're really related to, do I have as an investor the information I need in order to mitigate my risk, my climate risk, in fact. And as regards the other part of the problem, which is if we want to develop green finance, we need to develop the profitability of green finance. I would like to dwell on another big issue that is an old issue, is how you reveal the extra financial value of your green financing. Of course, that makes the link with all the ideas of having a carbon pricing and negative externalities pricing. But this issue is still on the table and not solved, so I put it again on the table. And we also need to have some planification. What I want to really dwell on is the fact that now green finance is available. If you have a project in the renewable energy sector, in refurbishing, in collective transport, etc., you can find financing all over Europe. The problem is technical assistance, how you have these projects emerge. And it's also to have some, of course, regulatory stability, regulation stability. If I take the example of regulation in the transport sector, the fact that the regulation on CO2 cars emission regulation is jeopardized is a big issue, because we don't have any visibility on what will happen in that sector anymore as an investor. So it's quite difficult for us to invest in the long run, because we don't know exactly when this regulation in the end will come into force. So planification, regulatory stability, but sectoral regulatory stability and blended finance. And I could also come back to what I have done with other European long-term investors, such as the Margaret Fund, which is a very good example of the climate club that can be put in place.
Wonderful. Thank you so much. We have very little time left, but I do want to give Sylvia a chance to react. And also, Sylvia, I will throw a question at you that already comes in online here, which is, can new types of insurance products specialized on climate risk improve financial appetite? So perhaps you can also reply that. And if I can look at the audience who wants to ask a question from the live audience, will be Jolt. Feel encouraged afterwards. But Sylvia, why don't you go, and then we go to Jolt and Stuart. You can have the last word then. Please, Sylvia.
Yeah, so my reaction to what has been said so far, particularly what Natalie said, is very short, because I agree on everything that was said. So absolutely 100% subscribe to the points that were raised. I think especially the point on, finance ultimately exists to empower what goes on in the real economy. So for finance to massively increase the availability of sustainable finance, then it does require that there is a clear objective to perform the real economy transition that is in the goal for Europe, at least has been in the goal up until this point. But then if there is uncertainty as to whether that goal is going to materialize or how that is going to materialize, with what time frame and so on and so forth, this is obviously creating uncertainty that doesn't really help on the financial side of things. She mentioned transport legislation. We could talk about the ETS, which was in the news these days, and it's a very similar kind of discussion. On the insurance question, I think it's a very, very interesting question. I think one area that is receiving more and more attention, for example, here is it's a little bit of a financial niche so far, but the area of insurance-linked securities, such as so-called catastrophe bonds, which would basically allow insurance to diversify away via securitization the risk of effectively climate insurance that they are extending out to the real economy. And instead of adopting the traditional model of reinsurance, this would be a slightly different model where the reinsurance function is effectively performed by a specific dedicated financial market. I think it's extremely small so far, and especially in Europe, it is basically non-existent because much of the issuance of this product is in the US right now. But it is something that maybe some of you have read was in the news in the context of the hurricane that hit Jamaica a few months ago, because that was the very first ever catastrophe bond that was triggered. So it is a discussion that I think is coming into the light that may be an interesting angle to the whole insurance question.
Thank you, Sylvia. So let's take the question from Jolt, Annie, and from you. And please identify yourself. Jolt Davasch at Bruegel.
Yes, thank you, Güntram. So my question is very simple. How likely that we will reach this major investment need in green investments? And the reason I ask, if I look at projections from the IMF, the European Commission, and the OECD for the overall investment rate of the EU, then basically they say they remain at the same level. But it's not specific to green and non-green, but it's very unlikely that within an unchanged overall investment rate, the non-green component will drop by 3% of GDP and the green component will suddenly increase by 3%. It's also possible that obviously these major institutions are incorrect in their forecasts, but you mentioned lots of regulatory measures, but how likely you think that this will actually happen?
Thank you.
Thank you. Roberta Laudazzi from DG Clima. I just joined. And since we're talking about mitigation and adaptation, there is like this word that has a very huge buzz at the moment. And we realize that is actually the way in which we can still get invited to some meetings, that is resilience. That is nothing else than the output of adaptation, but it's so much cooler at the moment. And also we realize that there are a lot of investors that are looking at that with private equity, not just insurance, but also of course as we said, a bank and everything. And also interesting companies that, I'm dealing with international relations, so that we can share our expertise, especially with Asian countries that we are very looking at. The question for you is do you see an interest? Do you see this trend too? And also there is this link that is funny enough about defense and resilience, and a lot of people are actually looking at the money coming from NATO, because 1.5% of the new budget is accounted for not strictly defense investments. So a lot of investors are looking at those money as resilience possible resilience investment for energy infrastructure and food security, supply chains, these kind of things. So I wanted to understand if you're seeing this trend.
Right. Thank you so much. Is there a third question from the audience? Otherwise, I would now give the floor to Stuart and Caroline for final reactions to what we've heard. And of course, Philippe, if you want to say something at the end, please also. Stuart, please.
Thank you. So on the how likely question, I'm a natural pessimist, but putting that aside, I think it's always going to be a challenge. We always knew it was always going to be difficult to increase that investment, but I think it's now about doubling down on the efforts that actually make that more likely. And I think one of the things we talked a little bit about in some of the regulatory space, and Natalie mentioned it, but actually investors being vocal on the fact that it doesn't seem likely that we can meet those goals if we don't have the stability in sectoral policy. I totally agree with that point. So I think, I don't know quite honestly on the likelihood, but I think there's things that we can do to be calling out that risk right now. And I think the resilience question is quite interesting. It probably is a whole discussion in itself, but we also need to meet the political context where it is. And I think a lot of the backlash we've seen around some of the rules in this space has actually been because we've not carried like the public mood. You know, people are worried about defence, and that's why there's a focus there. So actually, the link between long-term investors and sort of citizens also needs to be renewed, because actually, you know, your own background's a good example. So I think really being able to meet people where they are and is really important there.
Yeah, so I might respond to Josh's question. Although I'm usually an optimist, maybe I join you with being a pessimist in the sense that I mean we've in a paper we looked also at to what extent previous investment action was in line with the needs that were identified, and I mean, we found quite some shortfalls in terms of also in the previous years in terms of meeting these investment needs, which are usually for a horizon from 21 to 30. And obviously, I mean, if you have shortfalls, that means that, I mean, for the remaining years, you would need even more investment to cope with your targets. And so obviously, I mean, drawback or setbacks in terms of the policy. I mean, we mentioned ETS also. But also the regulatory environment, I mean, does not help. And we also mentioned defense. I mean, there are competing spending needs also for the public sector. So I would think it is challenging to keep the level high.
Philippe, did you want to?
Yes, I would like to make two remarks. So one is more general, that I'm really grateful for this wonderful opportunity to listen to a constellation of wonderful speakers and educate myself, because that's really my first experience. This project with Guntram is really my first experience with sustainable finance. I'm just starting to work in this area and absorbing all these arguments about the role of banks and the role of patients and the role of supply chains, etc. is very important for me. And another remark is more specific. I would like to specifically address the point I think Sylvia raised about mitigation versus adaptation investment. We actually do acknowledge this is a very important dimension, and although I skipped that slide for the interest of time, we actually do have an extension of our baseline model where we specifically address this mitigation versus adaptation issue. We do this more of like a robustness check, so that we can show our main results still hold if we take explicitly this distinction between adaptation and mitigation into account. But since Sylvia, you are not the first person who gives us this kind of feedback, maybe we should look deeper into that specific direction. Thank you very much.
Okay, so before we conclude, I want to thank Anna, who helped us with the project and with the research data. And Annabelle, are you here as well? So who managed the project, the events team, And of course, all of our speakers, Sylvia, Caroline, Stuart, Natalie, Philippe, and of course you, the audience, for engaging in this discussion. Thank you so much.